Oh, okay. So good evening, everyone, and thank you for joining our first episode of this new initiative called Your Market Navigator. Under this initiative, we intend to touch base with you, connect with you on every Wednesday from 4 to 5 with one of the experts, either internal expert or external expert. And through that, we would want to connect with you, share with you our views, and also answer or address some of the questions that you might have in each session. So this Your Market Navigator series, first of all, is going to be there on every Wednesday from 4 to 5. And in this initiative, we will be having a series of conversations. The first series of conversations that we are having is with analysts, because we all know that during COVID time, we have seen certain business models changing, business processes changing. In fact, many businesses are undergoing massive change in terms of their business prospects itself. So there are many changes happening at various sectors level or the business profile level, and therefore we thought let's start with the analyst series. So for the next 5 weeks, we will be having one or the other analyst of our investment team who will be sharing with you the changes that are taking place. Some of them could be cyclical, some of them could be structural, etc. And what impact will they have in terms of the changes? What these changes will have an impact in terms of the prospects, both in terms of economy as well as the market investments. Over time, once we are done with our analyst series, we'll be having a CIO series, our fund management series, and over time we will also have some external experts on the market and economy come and share with you their perspectives on the markets and generally what does it mean for the world of investment. This week, I'm very happy to share with you that we have Dhawal Gala, who is our a fund manager and a senior analyst with us. Dhawal has been in the capital market for the last over 13 years now, and he specializes in BFSI. He also happens to be fund manager for our banking and financial services fund, and specializes in this banking and financial services space, which is now a lot larger sector as such compared to what it used to be 5, 7, 8 years back, when, for example, insurance wasn't there, NBFCs weren't as large, etc. So a lot of changes have happened, and particularly during COVID time, we have seen that this sector has shown some different level of interest and volatility both in the marketplace. So we thought let's start with BFSI as a sector in this sector series that we have. Just a couple of points on the housekeeping before we get going with Dhawal. Number one is so Dhawal is going to run through a presentation for about 20 to 30 minutes, somewhere about 20-25 minutes. If you are interested in receiving this PPT, you can touch base with our relationship manager and with your relationship manager, and we'll be happy sharing this presentation with you tomorrow. If you have any question, particularly on banking and financial services sector or ABSL fund, particularly banking and financial services fund, we are happy to answer. Also, any market related question. We're very happy to receive a few questions before the session started. A few of the questions were for other funds. So I would request you to kind of park it for some time. We intend to address all your queries over time with different experts joining us. But today is the time for BFSI sector and your general market queries. So please keep posting your questions in the Q&A section. And after Dhawal completes his presentation, we will move on to Q&A section, and we'll cover possibly all the questions that you have. Dhawal, so just a couple of things I wanted to understand for our partners and some of the investors who might have joined, if partners have invited. And one is the role of analyst in general, because now we have 10 analysts in our equity investment team. And what is the role of analyst besides of course recommending? Because oftentimes I have received a query from some of our partners that in the same fund house, in certain funds there is an overweight particular sector, in certain funds there is underweight exposure in a given sector. So how does that analyst and fund manager conversation go? What is the role of your recommendation, or for that matter, any analyst recommendation for the fund managers to take their investment decision and portfolio construction? So that's question one. And another question that you just might want to answer before we deep dive into presentation is the divergence between the economy and markets as we speak. I mean, the prospects are weakening, have weakened for the last few months. Don't seem very, very exciting. But the kind of V-shaped market recovery that we have seen has really kind of created some bit of confusion among retail investors and also expert partners as to how to really read this market trend and economic trend and then what lies ahead in terms of future. So you just might want to touch base on these two questions, and then happy to kind of see your presentation. Over to you, Dhawal.
Thank you, Bhavdeep sir. Thanks a lot for this opportunity, and a very nice medium for us to give a weekly knowledge sharing sessions to all our partners and all our investors and clients across the country. First question, the role of importance of analyst. Very importantly, one needs to understand we are here specializing, analyzing companies bottoms up. We are the guys who keep meeting, talking to companies which we invest the money, investors' money, basically pulling off the assets which we do. We are the guys who keep reading about the companies, meeting them, and then we go and suggest the company's ideas to the fund managers and CIOs. And as a team, we go and meet the companies, understand the business models, the managements of the various companies, and basis valuations, we decide whether we have to invest or not. So the role of importance of the analyst is particularly to keep identifying ideas, keep evaluating these ideas on a day-to-day basis. Once invested, we need to also keep understanding that the prospects or the outlook of such companies are going as per our expectations or beyond expectations or below expectations. And then there is a course corrections which regularly one needs to do on a constant basis. So that is more of a role of importance. Maybe in simple words, I have put it across. One could always do Google and find out that what is the role of an analyst in particular organization. But that is a basic understanding. The second thing what I can talk about is we are a team of 10 people, 10 analysts in the team in the AMC. I cover BFSI sector. I have been tracking BFSI sector now, as you mentioned, for over 12-13 years. This has been my specialization. I've been running BFSI fund since our inception of the BFSI fund at Aditya Birla Sun Life AMC. All in all, what I can say is we are more, we keep analyzing and understanding the company regularly. And the second portion would be that basically a separate sector, separate guy just helps to differentiate and specialize the sector, which can help in terms of understanding trends within the sector really well. That has been the approach at our house. So we have been having different people doing different sectors for last many years. So that is what specialization brings in play. The second question on the disconnect between market and disconnect between the current equity market performance and the broader economic performance, right? So in my opinion, what has happened is interest rates have been cut across the board, whether it is India or whether it is globally. And that interest rate cut has helped bring in a lot of liquidity on the table. Definitely because of the pandemic, COVID-19, the fundamentals or the economic growth will take material time to come back. But what has happened is people have started shifting focus to next financial year when it comes to discounting in the market. And because of easier liquidity and rates being materially lower, the cost of equity proposition has gone down for companies at large. And therefore, one can consider that the prices have started moving in a faster manner. Now, whether this rally continues in the same speed, I would not hazard a guess here. I do feel people would have different opinions that this V-shaped market recovery was not expected or whether it was expected. What I can tell you is that the fundamental proposition for the country at large are improving. Economic growth may come back slower. The point is that we as India become more stronger in times to come. we can become explore more business opportunity, global business opportunities because of slowdown in our neighboring Asia, China and other countries, and we can also get material improvement when it comes to even our services sector. So net what happens is that India can come in flavor again. That is one part. Second, the overall global interest rates coming down and India's interest rates also falling off the cliff is bringing the cost of equity down, and also the point for excitement and improving valuation multiples. And what is happening is that India is only country where it can grow 7-8% again starting next year. So that is another expectation also, on one of the reasons why growth, or for that matter equity markets buoyancy is continuing so well. So that would be more of opening remarks from my side. If you want, we can start. I have a short presentation to make on BFSI sector, and basically I would talk about the key trends within the BFSI sector, what we are liking, how we are positioned, and from there we can continue to have a more interactive Q&A with all the participants, and Bhavdeep sir, you can moderate the session.
Sure, Dhawal, perfect. You'll share the presentation or I will do it?
Yeah, so I will share the presentation. And what you can do is, in between you can let me know if there are more questions or any questions basically you think you want to take it forward in between the session itself. That is also not an issue.
Okay, perfect.
So I hope the presentation is pretty clear to you, so I can start with my small short presentation on BFSI sector.
Yes,
is it visible to you?
Ahead.
Yeah, sure. Thank you. Yeah. So as I mentioned, right, what is happening in the banking and financial services sector. So let me first tell you what is BFSI sector as such. A decade back, if one would have looked at banking and financial services sector, we would have looked at key arguments between a public sector bank and a private sector bank. No longer that argument is now continuing, though people may have some questions regarding public sector banks. But the question now, or the movement now in the lending markets, have been for private banks or banking organization and NBFC companies. So NBFCs have emerged far stronger in the last 10 years. Definitely they have faced material challenges in the last 1.5 years. Then they used to be very small insurance companies, small AMC companies, and small general insurance companies 10 to 12 years back. That has now emerged as stronger and bigger companies. And definitely there are exchanges and other smaller components also within the BFSI space. So one looks at BFSI as a sector or a segment, right? It has varied segments, right from banking organizations, which is private and public sector banks. Then there are various NBFC companies, whether it is housing finance companies or asset finance companies or microfinance institutions or infra finance companies. And apart from these lending organization, one of the key importance which I am going to discuss in my end of the presentation is the non-lending financial services companies, or basically insurance stroke AMC stroke financial savings play. That is one of the key important theme which in my opinion will continue for the next few years. So a couple of key big themes which we are looking as a house, and we are bullish as a house within the BFSI sector, is big getting bigger, or basically one could say the significant shift of market share towards the large private sector companies, whether it is private banks or private NBFCs. The point is the disruption in the current era because of various reasons is giving easy market share gains to large private sector companies. So that is one of the bigger theme which I will go to talk about. And the second, as I mentioned, very important theme is the non-lending financials will continue to take greater share of financials value pie over the period of next few years. So to begin with the first theme, this is very important to understand, right? That the top means this is the market cap movement, the first chart on the left for the across Indian banking and financial services organizations running between 100 to 150 companies, all small and large, private sector as well as public sector, bank and NBFC, insurance across the market share. The market cap today is moving like this. Definitely it has seen sharper fall around March, April 2020 because of COVID-19, but it has started to bounce back. But if you look at, right, the top 6 private sector companies, which is largely ICICI Bank, Axis Bank, HDFC Bank, Bajaj Finance, Kotak Mahindra Bank, HDFC Limited. If you look at these top 6 private sector companies, the market share gain they have, or the market share they have within the overall market share is pretty large. So they comprise of more than 50% market share when one looks at overall market cap of the country's financials. And even if you look at loan market share, the loan market share today is 25% for these large lenders. And one looks at the way they have seen increase in the last 5 years. They have increased from 18% to 25% now, and they are further likely to increase closer to 30% in the next 2 years, purely basis the weaker or the smaller lenders are facing many challenges versus the easy way out for the large lenders. Even if one has to look at the large 3 top lenders within the sector, their operating profit, which is pre-provision operating profit market share, if one has to look at, is already at 27-28%, which is more than 1/4, whereas the 3 players constitute close to 20% of market share. So there is material improvement when it comes to market share in terms of operating profits. And in my opinion, in the next 2 years, this will become more than 33% for these 3 companies. So that is the way the large lenders are gaining market share, not just in terms of business, but also in terms of loans and operating profit. If you look at how this has changed over the last few years, at more detailed, if you look at the large private sector banks, right? People keep asking me how much they can grow, how well they are positioned, or how much upside would they have because their valuation multiples are higher. I can only say the way they have been able to garner market share in the last 5 years from public sector banks has been tremendous, and that, in my opinion, can continue in the next 5 to 10 years at a similar or in fact higher pace. And if you look at the second chart on the top right, this data suggests the large private banks versus all other private banks, whether it is mid-sized private banks or old generation private banks, they have gained massive market share. Yes, there was a reason of Yes Bank morat, because of which Yes Bank lost deposits and a lot of smaller banks lost deposits. Therefore, they lost market share last year. Even then, if you look at the top 4 private banks, they've gained market share massively. Even if you look at the way their capital adequacy ratios or liquidity coverage ratios, they are standing pretty strong versus all public sector banks. If you look at on the third chart or the bottom left, you would look at the CET1 ratios being ahead of 12-13%, and you would already see the news of ICICI Bank, Axis Bank, or for that matter, even mid-sized banks wanting to raise capital purely to be better off for growth opportunities which will come in the future, and also for the problem loans which will get created because of COVID-19 macro issues. So that is how better placed the private banks are. If you look at overall growth rates also in the last few years, the private sector banks, the large private banks, have constantly grown in the number handle of 20% odd. And apart from this financial year where they will face little bit of pressure on growth, they continue to grow, in my opinion, between 15 to 20% for the next 3 to 5 years, except for FY21. So that is the strength of the larger players. If you even look at public sector banks overall, State Bank of India saw a consolidation. They merged all their associate banks. And since then, which is FY17, you see the growth rate has collapsed for State Bank of India. If you look at overall basis, even now, State Bank of India is not growing beyond the market system growth rate. Similarly, what is happening in current financial year, there are 4 big banks in public sector banks which are merging smaller or other banks with themselves. And if you look at example of Bank of Baroda last year, which merged Dena Bank and Vijaya Bank, what is happening is this 34%, the right chart, the total of this market share, in my opinion, is not going to grow at all in the next 1 or 2 years. They would continue to consolidate, therefore throwing a material opportunity for private sector banks. If you look at the rate cuts which the country has seen, almost more than 250 basis points of rate cuts have happened over the last 18 months, especially in the last 6 months since COVID-19 issues. There has been material rate cuts by RBI even in the last 3 to 4 months time frame. You look at the term deposit rates offered by the large private banks, and for that matter the larger mid-sized private banks and the public sector banks. You would look at HDFC Bank and ICICI Bank, Axis Bank having the lowest term deposit rates, and the change or the cut they have already seen in versus the peak rates of 7% they were offering to 5% they are offering now. And if you look at the mid-sized banks, they have not seen much of rate cuts, maybe one because of the Yes Bank issue, and the other in general flight to safety to the larger private sector banks. So that is another positive for the larger private banks even within the private sector lenders. If you look at the second chart and the third chart, they all are suggesting how large private banks are ruling the roost right now because of low cost of deposits they are able to borrow, raise from the market. Even if you look at savings account rate, the changes one could see within the rates they used to offer of 4% for large private banks have now started offering 3/4 to 3.5%. And whereas the smaller private banks are still offering rates which are much ahead of the term deposit rates the larger banks are offering. So that is the importance of bringing the costs down, and therefore for that matter they'll be able to garner share not just from the private banks but from the public banks, but also from the smaller private banks. Even if you look at the cost of deposit franchise, the larger banks are largely benefiting materially when it comes to cost deposit market share. So maybe just to highlight you the third chart on the top, this is how the market share gain has happened just in the last 12 months for the large private banks versus systemic as well as the smaller private banks. HDFC Bank has gained market share from 7.2 to 8.1%. ICICI Bank has gained from 5.1 to 5.5. That is the improvement which is one is seeing when it comes to deposit mobilization improvement. Even if you look at MCLR, which is the minimum lending rates which these banks offer, right? If you look at the large private banks have already seen a cut of 100 to 150 basis points, whereas the smaller private banks have not been able to cut MCLR by more than 100 basis points even now. What happens is all the large corporate or premium clients which you would want to lend to would be going towards larger private banks versus the mid-sized public private banks. Even if you look at versus SPI and other banks, the rate differential is materially higher for the smaller private sector banks versus the larger private sector banks. This one important thing one looks at will be very useful both on the deposit, lower cost deposit, and on the lending. You get high quality lending at a very efficient pricing versus public sector banks, as well as your differential between the mid-sized private banks is materially at 100 to 150 basis points. So this is benefiting the larger banks. Even if you look at on the asset side, the home loan rates, right? This is a very important product, and everybody affiliates to this product because everybody would have taken a home loan or would be wanting to associate on the rates what the banks are offering. Even if you now look at the rates offered by the private banks is amongst the lower ones, and they are now getting closer to public sector banks, whereas the service efficiency the way these private lenders offer. Even if you look at the bond yields, now they are lower. Basically the 1-year term deposit rates are also materially lower than the AAA bond yields, etc. Again, this is pointing towards even the NBFC or money market borrowing the companies used to do. This shift also will be seeing towards the private sector banks. Even if you have to look at, as I mentioned in my opening remarks, what we can see in the next 5 years, in the last 15 years, if one has to look at the private sector banks, which is including all small, mid-size and the large, has gained market share. They've doubled the market share in the last 15 years, which is from March 5, they've gone to from 19% to 38% in the last 15 years. In my opinion, in the next 5 years, they can go to 52% market share. So basically, in my opinion, in the next 5 years, they can repeat what they did in the last 15 years. In this, the basic assumption what we have taken is that SBI will continue to do fine in terms of growth rate, but the other public sector banks will continue to face music, and also the smaller private banks and small finance banks will not be able to match the larger private sector banks. So that is the first important point or theme what we are looking at. So large private banks would be key portfolio positioning for us, whether it is HDFC Bank or ICICI Bank, which we remain very bullish on. And moving forward to maybe just to give you a general update on what is happening on asset quality, because that is one of the key discussion points on a constant basis. I'll talk about the asset quality views, which is our research and our expectations basis the larger companies we keep interacting or looking at their data. So what had happened in India, right? Since 2008-9, we are facing NPA issues, or NPAs have been in the news flow. The only point I can tell you is we were at a fag end of corporate NPL cycle when one looks at FY20 end. But the problem was the COVID had happened very closer to the time when we were hoping for improvement in the corporate NPLs cycle. Therefore, in my opinion, we may have higher retail and SME NPL coming. At this juncture, the things are pretty unclear. Everybody is confused whether to conserve money or to repay money when it comes to borrowers' mentality, and therefore we are seeing larger moratorium datas and confusion whether the NPL scenario would become worse, materially worse than expectations in future. I can talk about is what are we expecting. The point or the problem is that this may not come out in the same manner as we are expecting in terms of the quarterly movement. Because of moratorium being announced, and there could be a likely restructuring which is in the public domain. Because of that reasons, there could be time in terms of recognition of NPLs. What had happened in 2008-9 during global financial crisis, there was restructuring which was allowed in a large way to corporate India. And because of that, what happened is a lot of NPLs took 3 to 4 years time to get recognized. Even in 2012 to 15 era, the slowdown in the infra stroke power stroke steel cycle, that also took 3-4 years to get recognized. Therefore, it is difficult to envisage what would be the gross NPA number in the next 2-3 years at current levels. What we are looking at, if you ask me personally, we are building in is, in my opinion, in FY21, the slippages, which is the flow of new NPLs, would double, and it would moderate materially in FY22 if the current moratorium ends in August. So you would have 1 or 2 really bad quarter, whether it is 2Q FY21 or 3Q FY21, but post that things would improve. But if at all there are no further moratoriums or no restructuring being offered by RBI to larger or the smaller borrowers, then only this would be the way picture would play out. Now, what we are building in is that in the next 2 years,
Dhawal, you have gone mute.
Extremely sorry.
No problem. Yeah, it's fine.
Yeah. So did you lose my voice only now, or it was means you lost me for some more time? Should I
just 10 seconds back. So you can just go ahead.
No problem. Yeah. So what we are trying to tell is that we are currently building a 6.7% gross NPA for private banks in our coverage universe. This includes the large and small across the board from 3.6% at end of FY20. When one has to look at that the last 2 years, the private banks like ICICI and Axis were showcasing losses or showcasing very low profits because they were continuously providing gross NPA of the past cycles. Despite that, what I am building is conservative approach of increase in gross NPA and net NPA ratio. This definitely includes increase in all mid-size and small-size private banks also. Again, if one has to look at public sector bank, and this is only the larger ones which we cover consistently, we are seeing the gross NPA ratio to increase from 8% to 12% for them also. This is my assumption. If you look at from a credit cost, right, the one important thing you should see is the left-hand line, left-hand chart at the bottom. This is the credit cost line item. If you look at, we were expecting this fall of credit cost to come down materially in FY 21-22. But against that, we are seeing a rise of credit cost that is largely to do with COVID-related issues. And in my opinion, starting FY 22, one could start seeing the improving cycle in a material manner. So that brings a massive confidence for BFSI sector if one is looking for a 2 to 3 year horizon. I can definitely take questions around this in the Q&A time. But what we are building today is conservative approach on NPA front when it comes to our numbers. And definitely I'll talk about why the price movement has been sharp or why the banks are looking to raise capital. Our point is that maybe asset quality will take time to get recognized, but banks are just wanting to keep a higher CET1 capital adequacy buffer, and they are also looking to remain ready for the growth opportunities which will start getting once the pandemic is under control and COVID-19 issues are behind us. If you look at why we are seeing some confidence, if you look at, this is one important part which people would be reading in the newspapers, is about the moratoriums the lenders have offered to a lot of their borrowers. So if you look at, right, the last disclosure, which is 4Q FY20 results, and there are few companies who have reported first quarter results, we are already seeing improvement when it comes to the moratorium the people have taken. So now if you look at this data, right, and these are averages across private banks, public banks, housing finance companies, NBFCs and sector at large. 30% of borrower at sector at large had taken moratorium in the month of April because everybody was scared that they wanted to conserve cash. Everybody thought that this is basically an opportunity for me to conserve cash with myself rather than repaying the loan. And a lot of people also thought that the moratorium is something like a interest-free, free period, holiday period for not paying. The point is it comes with a heavy cost. You have to repay with interest and penal interest in future. And a lot of people have started understanding that and therefore started paying back. So not all the moratorium is the people who are facing economic issues. Secondly, if you look at the data disclosure on the right-hand side chart, if one has to look at how many people have started paying or what is the improvement, we can already see the improvement of moratorium data across banks which has delivered their results at this juncture. We are seeing sharper decline in the moratorium data. This is one important point, is giving us confidence. Or right now the prices are moving really fast for few companies. Basis this information, purely basis that people are seeing that the moratorium just will fall off the cliff. But just to give you one perspective why I still remain conservative, or take you back to this slide, or keep telling you that my expectations are conservative when it comes to NPA management, is purely basis that the NPA may take time to come, and even the moratorium data reducing to half of earlier recorded is purely that good people are going to pay up very fast. The tail of the moratorium is the thing which will create material issues in future. That is the place where you would have higher NPL issues in future in the next 1.5 years. Therefore, the quarter ending September would be important period when the moratorium ends, and we'll see the reality when it comes to actual NPL cycle in the next 12 months. And that may decide the price performance. Coming to valuations, and then maybe I'll talk about the second theme. The valuations have corrected sharply across banks. If you look at the topmost chart is the composite bank price to book valuations. if you look at large private banks, they are still below their mean valuations, and mid-sized private banks and public sector private banks are one standard deviation below their mean valuations. The point I am trying to say is a significant problems which COVID-19 has showcased to macro as well as banking in India or lending companies in India. In my opinion, that is in the price. Definitely, we will not go back to our bottoms, but even in the now next 6 months, I don't see we are going to go above or cross the mean valuation so soon. But we are getting confidence basis improvement in moratorium data that we could again trade back to the mean valuations and keep moving better over a period of next 18 to 24 months as we end the credit cycle of which has come because of COVID-19. To move to my second important theme, and then in 5 odd minutes time I should be done and we can open for Q&A, is about the financial saving scheme, saving story, or the importance or significance of the non-lending financials. So as I said, and if you remember people who have heard me in the past, I've always said that there is more to banking than private banks and public banks, which was there a decade back, or when we launched our fund 7 years back, that we would invest in private banks, very less in public banks. We would invest in NBFC companies, smaller NBFCs then, which has now become big. Some examples like Bajaj Finance or Chola Finance. And we would also look at newer companies within the BFSI segment. So if you look at my portfolio today, even the Aditya Birla Sun Life Banking Fund, or you look at the portfolios across Aditya Birla Sun Life mutual fund schemes, you would see a massive increase in the portfolio positioning in insurance sector and non-lending financials. When I mean non-lending financials, I'm talking about life insurance sector, I'm talking about general insurance sector, I'm talking about AMC companies, and I'm talking about all other smaller exchanges, rating agencies, and brokerage companies. Now, if you look at, let me take you to the market cap movement between the two segments, which is lending segment and the non-lending segment. In 2012, definitely a lot of NBFC stroke non-lending financial companies were not listed and large. So the market cap differential was driven by the public sector banks and the private sector banks then. They used to have 3/4 of the market caps. And if you look at the lending organization was the market cap then, because there were no listed companies in the non-lending space. In the last 3-4 years, you saw listing of large 4 life insurance companies, large general insurance company in the country, private sector, and you have seen AMC companies getting listed. And if you see the right hand side now, the increase in the market cap or the movement of market cap between the lending and non-lending, right? It has now become 1/4, 3/4 versus nothing, say 5-7 years back. So point I'm trying to drive is this keep shifting of the pie of market cap movement will continue towards the non-lending space, which is insurance, life, general, and AMC companies, which is corroborating with the financial savings play within the country. We do expect that around $2,000 of per capita income the average Indian household has today is likely to double in the next 7 years' time. That will bring in a massive inflection point when it comes to retail lending and also comes to the retail insurance, general insurance, and AMC sector at large. People used to ask me in the past, what is the difference between private sector and public sector banks 10 years back? The point then I used to answer is the ability of raising capital, growth capital regularly was one of the important points. Stronger management and continuity of the management was second important point. And the third important point was underwriting skills, especially in retail lending. So banks, the private sector banks had a strong retail franchise versus the entire public sector and even the corporate private sector banks. If you look at today life insurance companies or general insurance companies, you look at the retail business they do versus say LIC in the public sector space, or the public general insurance companies have more B2B business versus the B2C business. I'm sharing one example on life insurance sector, why we are very bullish. Even one has to look at the last 3 months, the life insurance companies prices have come back to pre-COVID levels, most of them. One. The second, they've outperformed the lending organizations already. And you would see our portfolios also have now material shift towards having these companies in the portfolios. I'm just giving you one bigger picture example on life insurance sector, and we have similar thought process on general insurance in AMC segment. So if you look at what we are looking at, I have already spoken about NPA quality issues for private lenders or overall lenders, including NBFCs. The insurance companies in India do not have such problems. So for us, in my opinion, they would grow their enterprise values or embedded values by 12 to 15% post dividends in the next 3 years, whereas private sector lenders may not be able to grow their book values by the same rate in the next 3 years other than fresh raise of capital. So that is one important point, that why life insurance companies do well versus private lenders also. If you look at, as I said, this is a sector where private banks, Axis Bank, ICICI, HDFC Bank was 10-15 years back. They are competing with smaller private insurance companies and big daddy LIC in the public sector. The four large private sector banks, in my opinion, are able to gain massive market share. They have large private bank distribution partners, and they have a very strong product profile. Another important for life insurance sector in India, because of COVID-19, one has started importantly looking at life insurance as a subject, which is term plan or a protection business. And even today, if one has to look at a poll, if we can do from our current thing, we are definitely, this is not a polling thing, but I'm just saying everybody of us is underinsured when it comes to having a term plan. I have few data points to make. If you look at the first left chart, Indian population is massively uninsured, and even people who are insured are under insurance or having lesser sum assured versus their likely income or one should have. Even whatever general term plans which we have, a massive portion of that is a B2B or a corporate term plan rather than having a direct B2C or a retail term plan. I have showed you the comparison of product sum assured as a percentage of GDP versus other countries where India suffers. So India has been a savings market even in the general in the insurance space, whereas protection business is the space where we have highest margins as a business. So in the next few years, if you just this chart, if you could look at the leftmost chart, what is happening in the last 2 years, private insurance companies are able to improve their protection business massively. And because of that, their VNB margins, one of the important factor, is increasing massively. If you look at FY 21 to 22 data for the top 4 private sector companies, they are seeing margin steadiness or improvement. And you look at there, because of the product mix change towards protection business, which has close to 80% margins, versus ULIP, which is AMC like a product, which has only 9% margins. So that is one important aspect. If I have to compare Indian life insurance companies versus global insurance companies, we do not take much of a credit risk, and we also do not take interest rate risk by selling non-par products in a material manner. LIC is able to do that because it's sovereign, and it is the business model they have followed for last many years. So if you look at, there is no comparison of product profile between LIC and the top 4 players. They are ULIP heavy and they are selling protection business materially, and LIC has been absent in that 2 product. I am not taking the same details when it comes to general insurance or AMC, but these are the trends which I was wanting to look to focus to tell that how the non-lending companies within the financials will emerge winners in the next 3 years' time. Just to conclude my part, I am just trying to say 2 key themes. Big is getting bigger. So our portfolios would have larger banks in a material overweight position. We remain neutral to overweight positioning across our funds in BFSI space, but our overweight position is driven by larger private lenders and the non-lending companies because they do have very lesser weight in the benchmarks, and my conviction is really high on these companies from a 2 to 3 year horizon. Within the banking and financial services fund which I manage, if you look at the style what we have been able to continue for the last many years, we've been buying companies which could give 15 to 20% compounding returns, and we've tried and stick with large companies which can grow, outpace the market average growth rates within each segment, and companies which are having higher market share or higher profit share within the space. And if you look at today, the insurance a percentage of the portfolio would be more than 20 to 23%. In fact, it is closer to 24% now if you include even the holding companies, couple of them which we have. So we have a very healthy mix between general insurance and life insurance within our portfolio in Aditya Birla Sun Life Banking and Financial Services Fund. Then we have large private banks, and we have niche or companies like Bajaj Finance or Bandhan Bank as one of the very high overweight positioning, which we feel that they can continue to grow between 20 to 25% post FY21's COVID related issues are over. So maybe Bhavdeep sir, I can end here and we can open the forum for question and answer, and maybe we can discuss stuff accordingly.
Sure. Thanks, Dhawal, for taking us through this detailed presentation, and particularly your two themes getting bigger. And second thing is the rise or the emergence of non-financials into this BFSI space, and what does it really mean for our investors and partners here on the call. So there are a few questions which we have received, and a series of questions, in fact, right from the big theme of getting bigger. What does it impact? So let me just read out those questions directly so that we get it verbatim from our viewers here. So one question we have here regarding so Mr. Atul is asking, what's your view on private banks, PSUs and NBFC's future NPA concern? I think you all answered almost all of them. YTDs, all three are laggard to Nifty and Nifty 50. So I think you have answered Dhawal in terms of your the prospects in your view. But in terms of performance, the recent performance has been underwhelming, we all know. So what does it mean in terms of the market performance also in the next few quarters? So you just want to touch upon that.
So Bhavdeep sir, what we can look at it is, right, 3 months back or beginning of April, right, when everybody seemed to be coming to an end, Nifty was around 8,000 levels. The consensus view which had emerged was that financials weight will half in the benchmarks like Bank Nifty, Nifty and Nifty 50, or in general the benchmark weightages will fall for BFSI sector. They had gone beyond 40% in Nifty 50, and therefore people had opinion that this sector will continue to become a material underperformer. In my opinion, then what we did was we maintained our equal weight stance on the sector. From slight overweight which we had in the month of March. So we definitely had underperformance because of that. But our opinion, as I spoke, was shifting within the space was to larger private lenders and these non-lending organizations. And in my opinion, in the 3.5-4 months, that has helped. Even if you look at the Banking Financial Services Fund, has seen improvement in the fund performance in the last 3-4 months versus the last 1.5-2 years. Now coming to question of what is the fate of banking and NBFC companies. So I've very clearly articulated asset quality issues are here to stay for at least next 12 months. The more faster they get recognized, the more importantly 3-year picture will emerge, which would be very bullish on this sector, the fund, the sector fund, and also the segment for all our funds within basically the BFSI sector again will start outperforming post the next 6 months time horizon, in my opinion, from a next 18 to 24 months time. The second big picture view one has to answer, maybe that is part of few questions which I am also reading, or maybe generally people have, that what is the future of BFSI sector, or whether the weightages will keep coming down or will keep going up, because people try comparing us with US or try comparing basically with NASDAQ or some indexes like that. Point I can only tell you is, the private sector lenders in India are digitally ready. They have been able to disrupt themselves really well. When I have to talk about HDFC Bank or ICICI Bank or ICICI General Insurance, HDFC Life Insurance or Bajaj Finance, they are digitally very good. or they have been able to do really good job even in the current lockdown, which was there in the national, on a national, and even today, which is running in most of the cities. So in my opinion, there is not any tech company which will come from nowhere and become a big lending organization. Definitely, we have to be on our toes when it comes to disruption within the lending stroke financial services business. But I am of the opinion that these large players are ready when it comes to take fintech companies head on. So this is the question not asked, but I'm just giving a point that within the Nifty or the next 50 indexes, the sector weightages may not change materially. The movement between private lenders, insurance companies would keep going towards the favor of non-lending organization. That is my opinion, or that is how our house is positioned today.
Got it. Okay, great. Dhawal. Another question that I have, a little bit of, let me bring a personal aspect also to it, is that many of our viewers wouldn't know that, and you also wouldn't know that I know that you have a very good rapport, you command a very strong rapport with some of the marquee names in the banking space, including with Mr. Aditya Puri. Now, HDFC Bank is one of the top holdings for us. And what's your view? I mean, this is a lot. It's very public, well debated topic in the market place today. He's kind of stepping down, and what does it mean for the bank in general? So, any thoughts that you have on this subject?
So this is a very important subject, and this will means we'll be able to whatever answer I may give right now. First of all, I do not have a very great share of rapport with Mr. Aditya Puri, but definitely with a lot of marquee stroke, good financial services CEOs, we do have a very good interactions and good relations. The only point being, we keep meeting them. I keep meeting Mr. Puri at least once in a year or twice in a year. I would say HDFC Bank has been ready for last 2 years or 3 years when it comes to become or be a big process-oriented bank. I don't think so that the bank fundamental performance will weaken if Mr. Puri is not there. So definitely, if I cannot say the same for smaller private organizations, whether it is IndusInd Bank or for that matter even Bajaj Finance or for that matter even Kotak Mahindra Bank. Definitely the CEOs are charismatic leaders. They have a higher trust element for people like us or investor like us within the stocks, and therefore the stock prices have that premium valuation multiples over other companies. So whether this will collapse or not, say after the CEO retires, right? Mr. Puri retires in October 2020. In my opinion, most likely an internal guy is possible. Mr. Puri may not continue in the company or in the bank for sure, even on the board. That is what he's told in the newspapers or our interactions. But definitely he's going to be somewhere connected with the bank in some capacities, not on a regular basis, but somewhere. It would be time, depending on the market conditions then, that there could be some disruption on the multiples of this company. Just to give you a flavor, HDFC Bank used to trade at close to 22 to 24 times price to earning on a 1 year forward basis consistently for the last 10 years. In the last 2 years, it has traded between 16 to 18 times. On the price to book multiple, it used to trade more than 4x for almost 10-15 years in the period between 2004 to 2018. Now it trades between 3 to 3.3 times. So in my opinion, a significant multiple correction has happened, but it is not that everything is in the price when it comes to CEO change. So let us wait, keep our fingers crossed who is the next CEO, whether it is an internal candidate or an external. My personal opinion, the fundamental numbers of the bank do not see massive change the way it is changed, the changes are seen in any or many other organizations. So I would remain very sanguine about HDFC Bank as an investment idea, and it is still offering at least 20 to 25% upside on my price target basis, even at today's prices from a next 12 to 18 months horizon. And when I talk about that, I am definitely considering that there would be some volatility in the stock whenever we cross the bridge of CEO change.
Right. Right. Great. So from large bank to let's come to small bank, and we are coming towards the close of the session. So let me package two questions, and maybe you can answer both of them together. So one, Mr. Nihar is asking the question: which are the small cap banks which would fare well in this testing? So essentially, for smaller banks, what are the prospects? Because the times are tough. Some of them have been kind of offering very high rates for raising deposits. Credit growth has not been coming. NPL cycle, as you rightly said, or rather, as you pointed out, this year is going to be tough for that. So in this environment, how do you think small cap banks in general are going to fare? That's question one. And number two is, what's your the parting advice for our partners and investors here on the call in terms of how should they approach? In any case, as a fund house, we kind of suggest asset allocation as a core approach for building portfolio, and the sector funds. All fund put together should not have more than 10-15% of any investor's portfolio. But if someone wants to put some exposure specifically to BFSI, is it the right time? Should they go for lump sum or STP or SIP kind of approach? What would your investment advice for our investors and partners here on the call?
So maybe first thing, smaller private banks. Today, the next 12 months are going to be a big challenge for them. Of that, maybe they have passed the last 3 months already, but they would have material challenges for private sector lender banks. The point is, they are out of the market at this juncture, in my opinion. The starting deposit rates they are offering is actually the rates, or in an even lesser rate, that AAA or marquee borrowers are borrowing from the money market funds or other private lenders. So that is one important differential. This has to collapse or converge with the large private banks when it comes to deposit rates. If you remember, I show one slide which is showcasing how the term deposit rates have collapsed for private banks in line with public sector banks. But for mid-sized private banks, that has not happened. Purely basis, they are not seeing the flight of inflow of deposits the way large lenders are seeing. If you look at HDFC Bank and ICICI Bank and Axis Bank, who has reported, a couple of them have reported numbers in the first quarter. They've seen healthy pace and massive market share gain when it comes to retail deposits, term deposits, and CASA deposits in the first quarter of FY21. So that is something what these private banks, mid-size one, will face music. The moment they correct this and the rates converge for them, they would come back in the business. Next 6 months, in my opinion, is tightrope for them. Few players again will emerge stronger. Today, the multiples for them has collapsed below book value. So they are offering massive value when it comes to investing in these banks. The only problem being that the way the larger banks are gaining market share and profit share, the smaller banks would have to do or showcase material extra hard work for people like us to believe that they will be able to do that consistently. So that is one of the reasons that we will have to be extra cautious versus the large private banks for the mid-sized private banks. But just to make a comment here, mid-sized private banks would do well versus the public sector banks. They would do well versus all the mid-sized private sector NBFCs, apart from the large 1 or 2 NBFCs, which are doing exceptionally well. So net-net, they are going to be winner, but not as easy what it seemed 3 years back or 2 years back. Bhavdeep sir, if you want, we can take 3-4 more questions. I see the list is longer. Whatever you think are important, which will not been covered, we can take them if at all everybody's fine.
Yeah.
Yeah, and second question, so sorry, I forgot. Second question on asset allocation, I missed that part. The advice right now would be, if at all you ask me a straight question, would you be investing in equities right now because the price have risen so sharply? I would say next 6 months or 12 months, one has to invest in equities because this is an asset class which should deliver very handsome returns versus other asset class from a 3-year to 4-year horizon. The rates in India has collapsed, interest rates I meant. This will bring in lower cost of borrowing costs for all the borrowers, which is our investing companies also, which will bring improvement in their EPS in the next year. And therefore, there would be improvement in price to earning ratio, because I mentioned the cost of equity improvement because of lower rates. So I'm saying net equity pricing should improve. Definitely we would have massive volatility because people today think that the COVID is behind us. That may not be true, but definitely harsh lockdowns and issues which one thought in March, April is definitely behind us. So what I'm saying is buy the dips maybe, and stroke you stagger your investments in the next few months and buy all the corrections, in my opinion. You have not asked, but if you ask me whether one should be investing in Aditya Birla Banking and Financial Services Fund, I would suggest it looks very opportunistic and interesting for the next 6 months. When the fundamentals are down, you keep investing heavily to reap the benefits in 2 to 3 years time when everything becomes very good again for the sector and both the lending as well as the non-lending space. The other question you asked about the asset allocation, I think the answer is you go a little steady in investing and use this 6 months, even today, current prices at some corrections, to increase allocations towards equities.
Sure. Couple of more questions. Let me just bunch up 2 questions. Mr. Kingshuk Das and Nihar, both of them are asking question around rural economy and PSU space. How is it looking? I mean, rural economy has seen green shoots. What is the prospect for SBI or PSUs in general? So what can we expect in next 6-12 months in this space?
So rural economy is looking really good. First, they have not been affected to the way the top 10 cities in the country have got impact because of COVID-19. That is point number 1. The point number 2, they, if you look at the composition of rural or semi-urban economy, more than 3/4 of the majority is because of essential businesses or essential services business. And most of them did not get massively impacted during the lockdown. Definitely poor in India would have got impacted because of the lockdowns when it came to their labor or basically their livelihood income. But the way government has helped the bottom of the pyramid and even the SME sector, I think rural and semi-urban can come back very sharply. If you see the FMCG companies which have reported numbers even in the last 3-4 days, and definitely we would have an expert series in coming weeks, even on FMC consumer. The rural is showcasing a very improving trend and far faster than the national average. First. Second, you look at the monsoon. God's grace, the monsoon has been very good up to now across country. Even in the West or Maharashtra, we have good monsoons versus the last year or last 2 years. Maharashtra has been lukewarm when it comes to monsoon. I am talking about the entire state and not just city of Mumbai. We always keep getting torrential rains. But I'm saying monsoon has been potentially been better than expectation. And that also helps agri. And if you look at agri income is improving even pre or post COVID, on pre and post monsoon also. So in net, rural income suggests no problems. Rural demand suggests no problem. Company facing rural will see re-rating maybe. Coming to PSU as a question, PSU banks I have already showcased that apart from SBI, we feel that there is material consolidation which will continue for 12-18 months, and therefore problems when it comes to the prices or re-rating of the prices. Second, PSUs at large, if that was the question, there would be few companies which would come back maybe within the OMCs or within the power or some segments. But net as a house, we would look at rural facing and we would look at high growth companies from an overall equity standpoint.
Okay, that's super. Mr. Ritesh is asking what are recent entrants in the portfolio and what is the logic behind it. So any major changes that you made in the portfolio in last 3-4 months, and why did we do it? So
within the banking and financial services portfolio, the recent changes, as I mentioned, right, HDFC Life, SBI Life, ICICI Prudential Life, then in general weightage increase in ICICI Lombard, or Chola Finance Holding and Bajaj Bajaj Finserv. These are 6 companies. If one has to look at, they are part of insurance, life and general insurance space. We've increased material weightages in the last 6 months, especially post-COVID also. ICICI Lombard was there since last 8-9 months. We've just steadily increased the weight a little, and that stock has done phenomenally well. So that also had fallen below 1,000 rupees during COVID correction, but it has outperformed materially the financial space in the last 12 months. Definitely last 1 month may not have seen material outperformance when it comes to general insurance space, but the life insurance companies like HDFC Life or IPRU Life, SBI Life, they are close to they are only 10% lower to their close lifetime highs, whereas financial services index is more than 20% lower than their lifetime highs. So what I'm trying to say is that this is the space we've increased allocations. Maybe you can say we've doubled our allocations in the last 3 months within this space. From 12-13%, we are now close to 24 odd percent. We'll keep increasing share within this segment. We used to own HDFC AMC a bit, maybe valuations, we get a right entry, we would consider that company as well. So I remain very bullish on the entire non-lending financial space. We'll keep looking at companies within this segment. For the funds mantra or my style of investing is to identify a few companies which are either market leader or will keep gaining market share. Then whether the company is small is not a problem. And they should grow between 15-20% more of earnings compounding. And I'll continue to hold irrespective of valuation multiples then. If you personally ask me now, most of these companies are trading at life-high valuations or multiples which are very high. And for them also FY21 growth is going to remain a challenge. And if you look at, they also get challenges because medical tests are not easily doable, and both are medical tests are very important, whether it is life insurance or general insurance sector, before underwriting the policies, right? So apart from that issues, AMC has no issues like that. We are very much digitally ready. We can do digital KYC. So for that matter, if you ask me, maybe AMC is at inflection point. In next 12-18 months, we can have again a demonetization type of an moment in AMC sector, where the sector AUMs can grow at 30-40% again. And in my opinion, that will bring a lot of money and re-rating to the entire markets as well as financial services sector.
Great. So thanks for covering that last bit on AMCs and insurance and what kind of impact can that have. One question, and I think this is the last question we'll have for today, is from Mr. Jaikant Dand. He asks, how strong is Bajaj Finance model? And I think it's very important question, because NBFC, every time we have seen the new economic cycle takes place, there are different set of leaders, sectoral leaders which show up. So in last 10 years, obviously NBFC, particularly last 6-7 years, NBFC is at a very good run. So is that run going to continue and consolidate from here, or you think it's going to kind of take some pause?
So this is a very good question. If one has to look at our portfolio, right, NBFC, especially Bajaj Finance, have been our large holding since last many years. First time at the inception of the fund, this stock we bought at for 135-140 rupees, the like today's price. Just to give an example that we've been holders in the company since long. We've only sold this company to book profits or be not going beyond 10%, which is the sector fund limit. Today also we own close to 9% of the company in our portfolio. I remain fairly bullish on this. So what I look at as an analyst, right? Maybe I should have made this comment in our opening remarks. And this is something I've been talking, all our analysts talk about, is when we identify company, we focus on BMV concept, which is business management and valuations. Within the financial services space, the management quality and the delivery of the business model they envisage is very important. And that brings in consistency and therefore valuation re-rating, right? So this is a basic concept which all our analysts follow. And I also follow is the capital raising and capital efficiency, because my sector runs only on capital. Bajaj Finance is very well capitalized today, 25% CET1 ratio. Today they have massive liquidity. they are borrowing at cost of funds which would be lower than all the mid-sized private sector banks. So that is the benefit what a large marquee NBFC with a strong promoter like Bajaj Group brings on the table. That is truth even for AB Capital, or for that matter L&T Finance, or many other brand MMFS brand marquee NBFC companies promoted by marquee promoters. But Bajaj is actually seeing cost of funds even lower than these names by close to 50-75 basis points, even in the shorter end in the last 3 months when people actually face liquidity issues. Bajaj is the only player who can deliver fintech opportunity, whether it is lending or savings, versus any other bank or any other fintech company. This is in true domain of fintech organization, in my opinion. Therefore, they have always got higher multiple than the entire sector at large. And that is the company why it has almost gone up 50-60% from the bottoms in the March-April month to now. If you look at current prices, definitely the company trades at close to 25-27 time price to earning. Today's prices, 1 year forward earnings, it trades at 4.5 times price to book. These are very high multiple than what HDFC Bank also trades for the consistency they deliver. But as I mentioned, right, this company has a potential to grow 25% CAGR for the next 3-4 years after COVID issues. Now let's talk about two key points. One, in India, the retail lending is still under-penetrated, and therefore the private banks have been able to gain profit share versus the overall lending organization profit share. First. Second, the delivery of retail loans have been far better for Bajaj Finance versus the top 3 private banks. Therefore, they've been able to gain market share, and they've been able to create markets within the retail lending space far faster than the other banks. You go to any consumer durable outlets, whether it is Vijay Sales or Chroma, you would see HDFC Bank and Bajaj Finance as the key competitor. If you go 3 years back, it was only Bajaj Finance. Now, in this business, you don't make big profits, sir. But in this business, you gain customers. And that customers, if you are able to give loans for next 10-15 years, you make big money. Now, today, Bajaj Finance has 4 crore customers. HDFC Bank also has close to 4.5-5 crore customers. Bajaj Finance has done all this in last 10 years. HDFC Bank has done all this in last 25 years. So that is the speed they are operating. The benefit towards HDFC Bank is they have liability side or savings account also, which Bajaj do not have today. So that is the difference or jugglery between a bank and NBFC. But these are the key important points. Largely from a top-down point of view, they are digitally ready, they are well capitalized, they are liquidity-wise ready, they are strong management, and they, in my opinion, after COVID, they can deliver 25%, 20 to 25% growth rate for next few years as a true retail organization because of under-penetration. And one more point to just add, not just on Bajaj Finance, but other companies like this. As I mentioned in one of my remarks was, today the per capita income in India is close to $2,000, $2,000 to $2,100 per capita. This, in our opinion, will double over the next 6-7 years. If you look at US or any developed countries, whenever the per capita income crosses $2,500 dollars and goes closer to $3,500-4,000, that is the time when you will see a J-curve in retail consumption, premium consumption, I mean, and retail loans. So it is benefit across banks and NBFCs who is doing retail. And they also bring in life insurance and health insurance in a material manner. So from $2,500 to $4,500, the saving proposition may plateau, but it will be higher than current level. But the consumption penetration would materially increase, whether it is retail loans, retail insurance, or retail health insurance. So that is how, if one has to look at 3 to 5 year horizon, that all themes will come into play.
Super. Thank you very much, Dhawal, and all our viewers on this first episode of this event. Very clearly, I think, Dhawal, your two themes were quite, big highlights. One is big will get bigger, and another thing is the non-financial space will get
non-lending.
Third, one very important aspect that I saw, and I heard you say, is about NBFC space, that it's kind of some of them which have established business model are going to really grow much faster and higher from here, simply because the core capabilities that they've built over the years. So thank you very much for all your insights and being with us.
Thanks, Bhavdeep. Thanks the audience. Thanks the audience. Thank Bhavdeep for very nice questions. And thank you for extending the session by 15 odd minutes. And I hope we've not bored the audiences. Yeah.
Yeah. So just one last announcement to all viewers and all my team members here. So next week at the same time at 4 o'clock on next Wednesday, we will have another conversation in this analyst series. My colleague Siddharth Damani will be in conversation with Chanchal Khandelwal, who is a fund manager for GenNext, and he is covering two important sectors, consumption and retail. So please tune in at 4 o'clock on next Wednesday to be a part of this analyst series. Thank you very much for joining us, and have a good evening. Thank you. Bye-bye. Thanks, Dhawal, once again.
Thank you, everybody.